Well, hello everybody. It's February 7th weekly review where we take a look at what happened and what do we expect to happen next. You know, there's no way to look at last week other than the fact that it was a major disappointment. Huge losses again, in particular on the NASDAQ, right? The NASDAQ was the one that took the hit, down 12.9, 13.2 on the Russell. S&P, the Dow holding up better, and that's because of rotation to those names, with the beaten down sectors seeing money flows to them, such as XLB, even some XLE, but elsewhere just total devastation. What's the biggest takeaway last week? Well, it's always a heads up when something that should happen doesn't happen. And if you look at the big disappointments of last week, there's probably none bigger than those ABCD structures, right? We were coming off the lows, right? Had the push up, and so that push up actually was to here. You had to pull back to there, and you were trying to get the push higher, right, towards that swing point low where we broke. Instead, we come right back down. We're testing into this little ledge that's down here, and folks, there's nothing here. I mean, other than what you see here, there's nothing to hold this thing up. You're at this right at that high of the low. That's the key spot. You know, if that gives way, and we're talking about 1812 at the low of it, 1876 at the high, you tested into it again, 1872, you've tested into it multiple times. They keep buying that support zone, but if that gives way, there's just nothing under there until you get to the lows. Now, it's even worse if you go look at the NASDAQ, because over here, those ABCD structures have actually failed. So in other words, you had the A point, the B point, right? You're going up and you're trying to make the C and get over it, right? And instead, and you did get over it, right? That was when they triggered. But instead of getting the carry through, right, the push to get the extension, instead it falls back down, and not only that, it gets back underneath all these lows. And yeah, one could say, okay, we rewrite this, and this was a question in the trading room this week. We could rewrite this and say this is still an ABCD structure, but now look at the value of it. There's just nothing there. And so essentially at this point, it's telling you that this is a busted trade, it's not going to work, and that whole ABCD structure just has lost its value. So at this point, NASDAQ is telling us something is definitely wrong. And not only that, as we just looked at the high of the low on the S&P 500, which was up here, NASDAQ clearly under it, deep into the big volume bars low. NASDAQ wants to actually push down and test that low. And if we drag over the weekly chart, the danger here is the NASDAQ is coming after the August lows. So those lows down around 42.92, I believe it is, that area right there, right? So here's the lows you're looking at on the daily. There's the lows on the August lows. It's going to go back and try to test them both. Now, what does that do if it breaks? Right? If you come down here and you get underneath it, what do? You're breaking here on the weekly time frame, pulling back to the daily, you're breaking on the daily time frame, and that's multiple swing point breaks, multiple time frames. That's always an issue, and that's going to be a big issue if in fact it happens. And that leads into the second bullet, which is the demise of this bull market is higher now than it has been since 2008, 2011, where it was trying to break down there. Now 2008 actually is kind of on the table in terms of that kind of scenario. I don't think we're going to get that, but then again, you know, when momentum gets going, sometimes it just carries, and it doesn't matter what you think because the market kind of has a mind of its own. The other big takeaway last week was the central bankers, the Bank of Japan. Remember, they had pushed negative interest rates, right? The NIRP policy. The whole point of that, of course, was to drive the currency lower, drive the markets higher. So it tested these highs up here. You got the NIRP deal, big swing back, right? And then what happens? They go all the way back to the highs, as if nothing happened. Is the central bankers, are they losing their control of these markets? I mean, for so long, they have totally controlled these markets. Of course, that move back in the yen, straight back up the way it was going. And if we look at it on the weekly, you're back up here to test these highs again. And finally, if we drag the monthly over, this is a rounded bottom taking place. If this gives way, in other words, if we actually do see this rounded bottom end up driving back up to the highs, right, then you got a real serious situation, right, comparatively, because we haven't seen that in quite a while. I mean, this is a monthly chart. You've seen nothing but declines in the yen, sideways, another big decline, sideways. Expectation is this. Now you're starting to get the pushback the other way. If it comes all the way back up here to test this, it kind of changes the whole dynamics of the way that chart looks. In general, bull markets die when all news is bad news, not good news, and they live when all good news is good news, right? In other words, there's always an excuse to buy. That's a bull market, right? But when it changes and when there's always an excuse to sell, which is what's starting to happen, you know, the earnings are bad, oil's bad, currencies are bad, you know, there's always some excuse to sell some more. That's when you get the major declines take place. And folks, this thing hasn't had a major decline in a very long time, and if it does break, it's going to be big. This is the NDX on the monthly. If we pull it back over and look at it on the, you know, the daily chart, that's that swing point low it's going after. Now the NDX on the weekly is a little bit different because it's got a long way to go. This has been what has driven this entire market and held it up all during 2014 and 2015. Right? It was the strength of the technology that held this thing higher, kept it up here, and actually made a new high last year when the rest of them couldn't. But ever since then, it's sold down, and now you're actually starting to get the real selling in the big names where nobody wanted to sell before. And you know, we're talking about Apple, Google, Microsoft, Amazon. If you pull any of these charts up and look at them, and then you have some huge destruction taking place elsewhere. You know, LinkedIn was down like 50%. I mean, this type of destruction happens towards the end of whatever the bull move is. Whatever's been holding it up, they finally start giving those stocks up. This has been what has held it up, and now those long-term winners are being dumped. And that's a big problem, especially if we see that continue for another week or two. And finally, if we look at another problem, right, another excuse to go lower, look at the DAX. You got a break of a swing point low here, goes confirmed bearish, right, or reconfirms bearish. So if you just look at the pattern, right, the pattern's about the same, right? Here you're making highs. You get the low, you go up, you round over, you make a new low. You go round over, you're trying to make new lows again, right? It's the same sort of scenario that we've seen in the Asian countries. Now, where they're supposed to have QE, where they're supposed to have central bank help, you're getting the rollover, you get the breakdown here, and you get it on the monthly. And so you broke on two swing points on multiple time frames. That says, always says, look out below, right? Danger point, multiple swing point breaks. This one's set up to try to go much lower. You pull it back here, you're at the ledge. If this does not hold this week, our markets are going to take a big spill with it. This is where you're at. You're at the last of the ledge. This is the target if you really start to break. And it's actually set up to do the follow through now given the multiple time frame break. That's about a 90%er on the way down. It's a big negative in my opinion and probably underplayed because it's overseas. You know, if you look for hope elsewhere, there's not much in the sectors. The only thing you got last week that actually held the S&P up was rotation into those beaten down sectors like the XLB, where we saw a big push up, right, in all these beaten down stocks. And in the XLU, of course, which is kind of a contra play, and that one is actually the other sector that saw buying last week. So that's what's helping the S&P look better. It's the technology sell-off that's making the NASDAQ and the NDX look terrible. That's what usually happens at the end of bull markets. If we look forward to what else may turn things this week, you got Yellen on the Hill. If she drops some sort of a bombshell like negative interest rates or the QE4, you know, that could turn this market short term, get some sort of a short squeeze going. But right now, you know, everything is, at least so far, of the form of short squeezes. We don't have any real buying interest yet. And until that changes, right, we're going to continue to see some sort of a decreasing valuation of these markets. And if we look out at the other thing that's happening this week is earnings, but I think earnings are going to continue to plague the market, not help it. In particular this week again, you're working down to the lesser known names, and most of those are probably not going to do anything to help this market. So on the bigger picture, right, if we think about the breakdown worries, it's really the DAX already doing the multiple swing point breaks, and it's the NASDAQ set up to do so. As I showed you, this to me, these two things are the things to watch this week. Do you get follow through on the DAX? And does the NASDAQ start to break down? And does it break down those August lows and start heading towards the October lows of 14? So what's the bottom line? Well, you didn't get the lasting rally out of the Bank of Japan. That's potentially a sign that the central banks are losing control. And they haven't done that for 6-7 years now. Those bullish ABCD structures, they failed. That's another sign of weakness. In other words, anytime you get a setup on the bullish side and you can't complete it in a weak market, that's just another sign that the market is just as weak or weaker than you think. And in my opinion, we got the greatest danger now for technical damage just over the horizon, in particular that DAX breakdown and potential NASDAQ breakdown. So what's the common scenarios? Last week, actually the worst case scenario played out. And if we look at this week, the best case scenario is for the S&P just to hold. As I was showing you earlier here on this particular bar, right, this is the bar that needs to hold. The ledge is right there. There's no room. If this thing starts to crumble, right, there's nothing until you get down here again at the 1812 mark. And so the best case scenario is that this holds here and trades in this area for another week. And then as part of that, you would probably see the NASDAQ unable to break these lows, and it looks like it definitely is going to try to test them, unable to break these lows, and therefore it could get the bounce. That's probably the best case scenario for this week. Whereas the worst case scenario is the NASDAQ doesn't hold. In other words, it breaks here on the daily, breaks on the weekly. Let me grab the weekly, breaks on the weekly as well. Right, and then there's nothing until you get to the 14 lows. 41.16 is those numbers. So that's the big danger point in terms of worst case scenario. What's most likely? Well, I think almost certainly we're going to test those lows. It's unclear to me whether they're going to hold or not, because if you look at the way this is coming down, you don't have the volume yet. In other words, the volume on the way down to test the lows is lighter. The problem with that view, though, is that you don't have a test. It's when you have the test that you figure out what the volume tells you. So we don't have a good clue. The only clue that we have is the volume did pick up a little bit as we broke on Friday, so that's a slight negative, but we're not talking about any huge escalation in volume yet. That's going to be the test. Is that test going to hold? I don't really know. If it doesn't, then we're going to have a big break, and I think the German market is the one that's going to tell us, and it's probably going to tell us right away Monday, Tuesday at the latest, whether it's going to follow through or not. So watch the German market and watch the NASDAQ. The likely case is that it's definitely going to test and potentially break it, and the German market will probably tell us which one it's going to be. I keep these themes here to remind you, last week you saw the huge bump up in the commodities, actually last couple of weeks. That was something that, at the beginning of the year we were talking about was a good possibility. I think the Fed was going to do nothing, maybe even reverse. We expected more QE. Japan surprised us and they gave us negative interest rates. I think they're going to have to do more QE still. And these equity markets, in my mind, are unlikely to crash. The more likely scenario is that what we're going to see, and I'll pull up the NASDAQ again, is some sort of a larger range build out at this area. So in other words, maybe the range ends up being this, or maybe even down to here, right, where you have the support zones underneath. But some sort of a larger range builds out versus something that takes you all the way back down to here. That's my expectation. We'll have to see if that comes true as the year progresses. I don't think we're going to get the crash. Now maybe you'll consider 20% down a crash. To me, a crash is 40, 50%, and I don't think that's on the table yet. On the fundamental side that we were talking about, right, the earnings have been a disappointment. What's interesting to me is the QE's down to 15 now. That's still high, but it's nothing like it was. The earnings are going to be 3.8% lower so far, and probably end up in that area. Sales, nothing surprising here, continue to be a struggle. 63% of the companies are reported. 70% are above the mean estimate. 48% sales above. So you can see less than half of them can meet their sales objectives. The other big thing is the Fed did nothing, but the Bank of Japan did, and got a big bounce off of it, but nothing happened, no follow through. Portfolio is down to nothing. I mean, and it probably should be down to nothing given the risk that's on the table here. If anything, it should be short. But at this point, it's down to nothing. It's probably going to stay down to nothing until something else makes us, gives us a better trade, either up or down. And at this point, really, you should be about preserving cash. You shouldn't be worried about trying to make money. I know it's enticing. There's always opportunities to make money, and if you're trading very short time frames and timing moves, Friday I detailed all day long the decline that was taking place, and the points that you could try to profit on the downside because it was clear we were going down. Once we got long and we broke the first setup to try to go long on Friday, it was all down from there, and I pointed that out all day long. So if you're day trading or if you're doing very short swing trades, you can time stuff and you can make some money. But folks, right now, if you're doing swing trades, right, in a portfolio, you're losing money. You just need to preserve cash, have very little exposure, and stay that way. Okay, so that's it for this week. I suspect this is going to be a do or die week. The NASDAQ is the key, and of course the DAX. So let's watch those, see what they want to do, and we'll take it from there. Have a great one.